September 30th is 2 days away, and we just did a deep dive on Lemonade. Should you buy or should you sell? Check out the course member live streams, link below. Okay, this is just absolutely insane. Do you remember back in March of 2020 when the Federal Reserve said they would print as much money as possible to make sure that markets are backstopped? They would bail out everything. They would bail out corporate bonds, they'd bail out public bonds, city bonds, municipal bonds, small businesses, big businesses, your credit cards, your car loan, your home loans. They would bail out literally everything to make sure we did not have a financial crisis. Remember that in March of 2020, right? That was okay because inflation then was like 1.5%. And we probably still overdid it with like 3 to 4 rounds of stimulus after those unlimited bailouts, right? We ended up having the shortest recession ever. I mean, we actually had the Larry Kudlow V-shaped recovery. Okay, that was a little too Trumpish versus Larry. But anyway, the point, he worked for Trump, so I guess that works. Anyway, what the Bank of England just did is going to have far-reaching consequences for everyone in the world. And you got to hear about it because, let me put it this way. Inflation right now is not 1.5%. It's actually 9.9% in the United Kingdom. That's down from 10.1%, but that's not a really big drop, okay? 10.1 to 9.9, that's still hellishly bad. And now, the Bank of England, guess what they've done, folks? They've gone back into the Titanic's boiler room and said, you know what? Screw the iceberg of inflation. Crank the engines and let's print some more money because we're starting unlimited bailouts again. I kid you not. The Bank of England is turning on the money printers and bringing back unlimited market bailouts. And it's all in reaction to the Federal Reserve in the United States aggressively raising interest rates. Okay, so let's break this down because there are a lot of moving pieces. So part number one, Fed aggressively hikes. This creates sell-offs in bond markets around the world. Let's try to clarify that a little bit and really simplify that, okay? When you can put your money into a risk-free, like there's zero risk, okay? I'm in the process, I'm in the licensing process to become a licensed financial advisor, okay? Past Series 65, like applying with the SEC and everything. The only thing you could call risk-free is the government's bond of the United States, treasuries. And those are generally what are called the risk-free interest rate of return that you could earn in the market. Well, that's at like 4% right now, which is insane that you could get 4%, no risk at all, 4% in treasuries. It's crazy. Just go to treasurydirect.gov and you could go shopping for them. Anyway, when the Federal Reserve raises interest rates, Fed funds rate, the rates on these bonds tend to go up. And that makes our bonds in America more attractive than bonds around the world, especially when you have the Bank of England, instead of deciding to do a 75 basis point hike, only doing a 50 basis point hike. That increases the wedge between the bonds in the United States, which have a higher yield, and then the British bonds, which maybe are going to approach similar yields, but don't have the security of those US bonds. So you may as well dump your British bonds, sell them, drop the prices of those, driving up yields of those, and move your money over, sell your British pounds, dropping the value of that currency, and move your money over to the dollars. All of this was now, well, I should say, fuel was added to the fire of all of this because the new Chancellor of the Exchange, which is kind of like the Treasury Secretary for the United Kingdom, the new Chancellor of the Exchange says that, hey, you know what? We're a country of entrepreneurs. And for us to make sure that we encourage job growth, since we have a lack of people applying for jobs and we need to fill more jobs, we have too many job openings, much like in the United States, we're going to take this approach of let's lower taxes on the rich and let's increase spending. So let's lower taxes on the rich and businesses and increase spending, which selfishly I'm like, damn, that sounds interesting. I like lower taxes on business and I like increased spending. I mean, like, who doesn't, right? But the problem with that is when you look at that gap, you actually create a massive issue because now you have less revenue and you create more risk that your government's going to default. So you have to increase yields on bonds and lower prices on bonds. You even have the International Monetary Fund, the IMF, and Morgan Stanley coming out going, what are you doing, Bank of England? Well, not Bank of England. What are you doing, government of the United Kingdom? Why would you do this? This is just going to crush your bonds. It is going to lead to a lack of trust in your government's ability to have a balanced budget. Nobody believes you can increase spending and reduce revenues. It's just not going to work. People aren't going to believe you. And so, as a result, the pound plummeted, as we've talked about a few days ago. But now, the Bank of England has responded because of fears of a massive, massive financial crisis. That's right. The Bank of England announced today that they will print an unlimited amount of money to buy bonds and stop the pain of the bond market because pension funds and institutions throughout the United Kingdom could go bankrupt under the weight of margin calls. Look, I understand this is like stressful and this is a lot to digest, so I'm going to try to make this as simple as possible here. Let's say you have a bond that's worth $100, okay? So you have $100 of bonds, and you have loans worth $60. If your bond goes down in value to $70, think of it like a stock, okay? It goes down in value to like $70. You're like, oh gosh, we're getting close to that debt that we have. And you might think, oh, well, just cover your debt, right? Oh, wait, a lot of our debt at our pension funds is tied up in private equity and real estate, which is extremely illiquid. Uh-oh, what if our bonds keep falling? We might get margin called and we might have to dump our bonds at the bottom of the market. And then we have a financial crisis. So the Bank of England has stepped in, much like the Federal Reserve during March of 2020. However, there are massive issues with this. And no, I'm not talking about the issue that September 30th is now 2 days away, and it is your best opportunity to make sure that you wire and get the most warrants for my startup house hack, househack.com. Learn more there, read the prospectus if you're an accredited investor. And it's also the expiration date for the coupons for the programs on Building Your Wealth, link down below. Keep in mind, the Wealth Path course is having a complete scrapping and redoing, and you are going to, in my opinion, get the absolute best deal if you buy the Wealth Path course under the trust that it's going to be freaking epic before the changes that we make this weekend were announced this weekend to the Wealth Path course. So stay tuned. I think there's some really exciting changes coming, and you're going to be able to lock in a really great price if you get in before Friday. So consider that if you haven't bundled up yet, and consider the other programs. You can bundle them all. Use those coupon codes linked down below, and the price will be expiring on Friday. So back to the Bank of England. This is literally insane that they're turning the unlimited money printer on while inflation is near 10%. The bank is going as far as saying that we were hours away from massive liquidity crises and that they needed to prevent forced selling. There are huge fears here that a big crash could come. And so that's why they're doing this to stabilize the market. In the short term, this is having the effect of actually driving down bond yields, not only in the United Kingdom via the GILTS, but also in the United States. Bond yields on, for example, the 10-year Treasury ran to over 4% last night. But today, they've actually fallen to 3.8, roughly 2%. And that's because of the unlimited bailouts happening in the United Kingdom. However, that is likely to be short-lived. This decline in treasuries or gilts in their yields is likely to be short-lived because the Bank of England, in order to fight inflation, is probably going to have to come out with a serious rate hike of 75 or 100 basis points by their next meeting of November 3rd. There are now concerns rising that they might even do an intermeeting hike. So in other words, on one hand, they're going to print unlimited amounts of money to bail out the bond market. And then on the other hand, they're going to have to raise rates to fight inflation. This is really dangerous because it could unanchor inflation expectations. This is very bad. They literally just turned on unlimited QE. That's not good. Now, there's some other things that happened this morning as well. I'm going to talk specifically in another video about what's going on with the Nord Stream pipeline and expectations that could happen here. But the sabotage of the Nord Stream pipeline has mostly been expected, but there are some unintended consequences of the Nord Stream pipeline shutting down. We're going to talk about those, including some risks to, of course, inflation, but not because of the Nord Stream pipeline. We'll talk about that in a different video. Instead, it's worth noting that Deutsche Bank is calling for a severe economic downturn that will continue for at least another year. Volatility will not be going away. And we have reports not only from Apple yesterday that they're cutting iPhone production. Make sure you watch my Apple video yesterday. We've got a Category 5 hurricane. Well, it's 2 miles away from Category 5. Basically, Category 5 hurricane making landfall soon here in on the west coast of Florida. Very rare, by the way, that these storms make landfall on the west coast of Florida. I grew up in South Florida. I've been through a lot of hurricanes. I've never been through a 4 or 5. The last 4 or 5 I can recall historically was actually in 1992 with Hurricane Andrew, which made landfall just a few months before I made landfall in Florida from Germany. Anyway, Hurricane Kevin. Wholesale inventories this morning rose a lot more than expected. We had an expected rise of 0.4% in wholesale inventories and a 1% rise in retail inventories. Those were the expectations. We actually got 1.3% for wholesale and 1.4% for retail. So a big beat on, well, I mean, I should say a miss because it's negative, but bad news on both of those numbers. Much worse than expected. We've got Lyft freezing hiring, DocuSign cutting its workforce by 9%, and Janet Yellen might be getting the boot after the elections. Janet Yellen. This is insane. It's but anyway, there's a lot of insanity happening. This is a pretty painful time. I'm gonna head now over to the course member live stream as I do every morning. Appreciate you being here for these videos. If you want to join those course member live streams, we did some incredible analysis, some deep dive analysis yesterday into Lemonade Insurance. Make sure you take a look at my analysis on that to see, is it time to buy the dip on Lemonade, or is this a stock to continue to run away from? Keep in mind, I sold Lemonade around $65. I made that clear to everyone, not only in the courses, but on the channel. Anyway, wish you the best out here. Thank you so much. I do not hold any Lemonade right now. Thank you so much, and we'll see you in the next one. Goodbye.